So if you're okay with our meeting being recorded, here is MEFA's Managing Student Loan Repayment for Graduating Seniors. I think you probably know how to participate in a Zoom webinar by now. We do have a closed captioning transcript that you can access if you want to read as we go along. I want to point that out. Also, if you have questions throughout this presentation, I would ask you to use the Q&A function instead of the chat function. So it's just easier for me to see that. There will be, as I said, we will have the recording handy for you to refer back to. And hang on one moment, please. I just need to. Excuse me, just need to take care of this here. Okay, so I apologize for the delay here. I want to tell you a little bit about MEFA before we get started. We're the Massachusetts Educational Financing Authority, and we're a state authority. We were created by the Commonwealth of Massachusetts back in 1982, and we have a public service mission to help Massachusetts families, or actually any families, to plan, save, and pay for college, and we do that in a variety of ways. What we were created to do, of course, at first was to offer a loan. And I'm not sure if any of the loans that you are here to learn about paying back our MEFA loans or not, but that was the first thing that we did. Since that time, of course, as the cost of college has continued to go up, just offering a loan didn't seem adequate. So we started 2 savings programs. And a lot of what we do is free educational sort of outreach and guidance on all topics related to planning, saving, and paying for college. So if you have any questions on repaying loans or any other facet of paying for college in the future, you can definitely reach out to us. We are a free resource for you to use. Now, today, and I would like to, again, encourage you to submit your questions through the Q&A throughout the presentation. We're going to talk about loan repayment and our first steps of what you have to do in order to get ready to sort of integrate your loan repayments into your life. We're going to talk about 2 specific programs, the federal loans and the private loans. And this is a really important distinction to make. You know, that is, they have really different rules, federal loans and private loans for repayment. And so you're going to want to pay attention to that. We'll talk about some loan repayment tips. We'll talk about forgiveness options. Forgiveness has been a hot topic lately in the news. And so aside from whatever's going on with the Supreme Court and student loan forgiveness, there are other forgiveness programs that are not affected by that were previously existing. We can talk about those. And we are going to touch on delinquency and default, so things that you want to avoid. And if you're in delinquency and default, how you can recover from those. And then finally, loan consolidation and refinancing, 2 things that get conflated all the time, but they're not the same things. And we'll talk about why they're different and when you may want to consider one or the other. And then finally, resources. We'll talk about some free resources that are available to you. We always like to point out that there is free help available for you, and this is no different. Okay, so one moment. So starting off with first steps. Okay, so the first thing you want to do is think about a budget. And this is going to be possibly new to many of you. And it's just something to get your finances in order. And so you can use a spreadsheet. There's always somebody who likes spreadsheets. There are people who like spreadsheets, people who like to write things down. This here is just an example of a budgeting tool that we have on MEFA.org. And basically all this is you want to identify all of your sources of income. So anything that you have coming into you, and then all of your expenses, everything going out. And it sounds simple, but it's something that really, the importance of it cannot be overstated. And so you want to start off in your financial life sort of on a good footing. Take a month, take 2 months, expenses come out at different intervals, see where your money is going. People who have been working for decades like myself often sort of overlook this. They think that as long as they've got enough money by the end of the month, they're okay. And when they do start budgeting, they're surprised by how their money is being spent, because it sounds very simple, as I said, but until you actually sit down and document where your money is going, you really can't move forward to be financially healthy. So you want to identify all of your bills and expenses. You want to distinguish between your needs and your wants. So needs are things like rent, if you're paying for your transportation, your health insurance, food. These are things, bills, these are things that you have to pay. You have no choice on them. Wants are things like entertainment, takeout, clothes, things that might be nice to have and we want to have them. And it's part of the fun of living is having these things, but they are wants. So you should revise as needed. So if you take a couple of months there and see that you're spending more of your money going out to eat than you really should, then you can revise that. And so many of you, I'm assuming, have not started repaying your student loans or have not been making your student loan payments as part of your regular budget. This is something that is going to prepare you to do that and to account for those when those come in and start repayment. Now, one thing you can do before you start making your loan payments is actually just know what you have borrowed. How many loans do you have? What type of loans do you have? And what are your balances? So I mentioned before that there are two main types of loans that you're going to start repayment on: federal loans and hopefully, if you've borrowed anything, you've borrowed some federal loans, and many of you may have private loans as well. Now, the resource to get information on the federal loans that you have borrowed is the federal student aid site, which is studentaid.ed.gov. And you can log in, and you should log in using your FSA ID, which is the username and password that you set up when you were filing your FAFSA. And you should be able to go and view the information about your federal loans. So that is, the amount that you have borrowed, the interest rate on these loans, your balance, your servicer. And your servicer is the company that actually handles the repayment of your loans. And this can be confusing because this is oftentimes, and especially in the case of federal loans, it is a company that has been contracted to do this. So you'll be getting emails, you'll be getting perhaps mailed letters or bills to you from these companies that you may not recognize at first. So just be vigilant and take a look at your emails and open your mail and see, because you may have a letter from a company that you're not aware of, and it's your federal student loan lender, a servicer, that is. So basically you want to keep in contact with your servicer. We'll talk more about that later on. And your loan servicer can provide your payment amount. So this is your monthly payment amount that you have to pay and your first payment due date. Now, federal loans go into repayment after the grace period has ended on them. And the grace period starts once you graduate. It's a 6-month grace period. Once you graduate or fall below halftime in the program. So if you're graduating in May, you're going to enter a 6-month grace in all likelihood. And your repayment then is likely to begin in November or December. Somebody had a question as to how you know what the payment will be once it comes out of a forbearance. And I think you mean a deferment, your in-school deferment. And that is something that you can check with your servicer. I did mention that. So you can call up your servicer of your federal loans and find out what your payment will be. Good questions. Keep them coming. Okay. Now, if you have private loans, that federal loan database is not going to show you your private loans. It's possible that you may have private loans from one lender or possibly more than one lender if you borrowed from different lenders throughout your time in school. They will also have servicers sometimes that they have contracted with. Like, for example, MEFA. MEFA is a private loan lender. We have partnered with a company called AES to handle the repayment of our MEFA loans. And when you're contacted, you'll be contacted by AES. So again, you want to be vigilant and open your mail or read your email, even if it's from a company that you may not recognize at first. So if you have loans out through private companies, and you want to know, how many loans you have with what lenders, what the balance was, et cetera, you can check with your financial aid office at your college because they will have records on that. Once you find out which lenders have lent you, private loan lenders have lent you loans throughout your schooling, you can check the lender's website and find out your servicer information. So again, if you went to MEFA.org and you had questions about repaying your loan, you could find the link to AES. Your loan servicer, once again, can provide your payment amount and your first payment due date, along with your interest rate and any kind of interest that's accrued on your loan since you've been in school. Someone wants to know when federal student loan service companies will be contacting students post-graduation. You should be notified as soon as your loan enters a grace period, which is when you separate from school. And so you'll be notified that your loan has entered grace and that you'll have 6 months grace and when your first payment due date is, and they'll be contacting you again as that date approaches. Thank you for the question. So if you do have multiple servers, the way you can prepare to make payments on these loans, you can create an online account for each servicer. It's just something that you want to do, especially if you want to make online payments or sign up for automatic withdrawals. It's probably easier to do that. Servicers may have a mobile app that you can download, or lenders may have that you can download and easily sort of make a quick payment or check the balance or check the interest due or interest rate on your loan. So that's something that you can do. I did mention this earlier. You can add your loan payments to your monthly budget, even if they haven't come due yet. And that's a good thing to do. In fact, you may remember, you may realize that we have been in a federal loan pause for the past few years. That is, anyone since the COVID pandemic, anybody who has had federal loans had them automatically placed into a pause, and they haven't been required to make payments on any of those loans in a few years, and that is ending in August. So a lot of people are going to have to try to figure out how they're going to accommodate for these loan payments that they haven't had to make in a few years. And so that's a good thing to do ahead of time, so you won't be surprised when those loans, or you won't be caught short when those loans do enter repayment and you do have to start making those payments. So grace period is something I mentioned already. You just want to make sure that the federal loan or private loan servicers, whoever they are, have your most recent contact information, so that you don't miss any bills or you don't miss any notices. That is not a reason to get out of delinquency or default. So it's up to the borrower or the student, whoever's responsible to repay this loan, to keep the servicer informed of their current address and contact information. So understanding your options for repayment is important. And these differ greatly between federal loans and private loans, and we'll get into that. It's good to know your interest rate on loans, especially if you want to aggressively sort of repay them, try to pay them off early. And I should mention that there is no prepayment penalty on any federal loans. And I don't know of any private loans, education loans, on which there is a prepayment penalty. I can't say for sure that there isn't any, but I don't know of any that do have. That means you can pay off early, and it's a good thing to do if you can do that, because that means you pay off less interest over the life of the loan, and it ends up costing you less in general. Just here. Some questions here. I'm going to answer those a little bit later on because some of them will be answered throughout the presentation. So when it comes to repaying, the most important thing, and you know, it sounds simple, but the most important thing I can really say to you is to repay on time. You know, that goes to your credit score and your credit report, which we'll talk about later on. Always make at least the minimum payment. So you'll have a payment amount due that's showed in your bills or on your account if you check your account. Using automatic debit is really convenient and a good tool to use. Just like savings, we know that people who use automatic withdrawals from a bank account to put money in a savings account end up saving more. And people who choose to have the payments automatically drafted from a bank account to repay their loan end up repaying them more regularly. And I can speak to my own experience here. I was, quite frankly, terrible at repaying my loans when I first got out of college and I had to sit down and write out a check or you know, call up and make a payment. I just was not very good at it. And to be honest, you know, I would fall months delinquent at a time. And eventually one day I just wised up and got on an automatic payment plan and didn't miss a payment, you know, for 15 years after that until I paid off my loan. There are some other options you can, if you have a 529 account, you are able to use a 529 account if you have savings left over after college. I know many of you probably don't, but if you're lucky enough to have some money left over in a 529 account after college, you can use up to $10,000 in a 529 to repay student loans. That's a one-time thing that you're able to do and not pay taxes on any of those earnings. If you do have money left over and you want to, as I said, aggressively sort of pay down loans and to try to pay them off early, you can do that. And different servicers may have different practices on how they handle extra funds. And it's funny, people bring their sort of assumptions to this. Sometimes people pay off or pay more than is due with the expectation that whatever's remaining is going to go against the principal. And some people do that and they'll just have their payment due next month as well. Some people think if they send 2 or 3 months at a time, it's going to pay next month's payment or next 2 months' payments, and they just won't be charged for those months. You know, servicers will have different capabilities and different practices when it comes to that. But if you want to pay loans off early, you want to make sure that you know what your servicers' policies are. And if you're not sure, just write down that you would like the excess amount applied to the principal. And again, a good practice, if you are trying to aggressively pay down these loans, is to pay off ones with the highest interest rate first, because more of your money is going against interest for the higher interest rates. And so, you know, less of it's going towards principal. The sooner you pay that off, the more your dollar is going to go to your other loans. Now, I mentioned to repay on time and how that impacts credit. The reason to repay on time and to maintain a good credit, maintain a good payment history is because it is going to affect your credit score negatively or your credit report negatively if you don't. The importance of credit, you know, is that your credit is important because if you're going to be making any big purchases, if you're going to be borrowing anything, you know, this is going to determine the interest rate that you pay or whether or not you can borrow or make a big purchase that you are going to have to finance. The most important thing when it comes to your credit score is paying your bills on time. Your credit can determine your interest rate. As I said, when you're borrowing for future purposes, landlords even will check your credit to determine whether or not they're going to rent you an apartment. So many of you who are just leaving college are going to go and look for an apartment. This is going to be important to you. Even prospective employers can check your credit, and that may affect in certain positions whether or not you get hired for a job. So it's really important that you maintain good credit. And as I said a few times already, the best way that you can do that is to pay your bills on time. Definitely you want to avoid default, and we'll talk about what default is. If you miss a loan payment that may show on your credit report, if you miss it by 30 days, you may be 30 days delinquent, 60 days delinquent, etc. And these negative marks on your credit report can stay with you for a long time and negatively affect your credit for a long time. So you just want to avoid that if possible. Everyone is required to, everyone is eligible to access a free credit report every year at annualcreditreport.com. And a credit report is just sort of a report run by the three main credit companies of everything that you have borrowed, or every outstanding line of credit that you have, what status it's in, how much you have owed, and what your payment history has been. So it's not at all uncommon for there to be mistakes on a credit report. So it's good to access that credit report once a year when you're able to do that, and to check for errors or things that are negatively affecting your credit report or credit score that should not be. And so again, that site is annualcreditreport.com. One of our resources that we'll mention near the end is Credit Karma. There are a lot of other sites, apps and services that are sort of credit monitoring services that will let you know what your score is. Those are all good things to have. Credit Karma, I think, and a few other apps, at least one of which we'll highlight on the resource page, also have budgeting capabilities. So there are budgeting apps as well that should be available for free. In some form or another. So also good things to do. So if you are making your payments and you're running into difficulty, or if you have questions, contact your loan servicer. It is the most natural thing in the world if you have anxiety around payment issues when you get a call from a servicer, especially if you've fallen delinquent, to avoid that. Do not do that. That's about the worst thing that you can do. Even if you can't afford to pay on time, servicers may be able to help you out with either a short-term deferment or forbearance or a lowered monthly payment. There may be options available for you, and we'll talk about what some of those are in just a few minutes. So definitely do not try to run or hide from that. Have a conversation with the servicer, see what options are available. And just maintain that dialogue with them, because nothing looks worse than if you're due for payments and you're not answering the phone or not, returning any messages. Also, one thing that we probably want to talk about now, especially in tax time, is that you can deduct, in certain circumstances, student loan interest on your federal taxes. And if you have student loans that you have been paying interest on, you should have received what's called a 1098E, I believe it is, a 1098E, which is a tax form that shows you how much interest that you've paid throughout the past calendar year. And you can present that to your tax preparer and possibly deduct that on your taxes, depending on your income situation. So that's good to know. Okay, now when we're talking about the actual nitty-gritty of repayment, again, we want to take this on two tracks, federal and private. So let's start with the federal loans first. The standard repayment term, that is the amount of time that you have to repay these federal student loans, is 10 years. Now, remember, the repayment begins 6 months after you graduate or leave the program, after your grace period is ended. And from that point on, again, you have 10 years, and your monthly payment amount is determined based on how much you need to pay in order to pay these loans off in 10 years. But one of the good things about federal loans, and one of the reasons that is that I hope you have some if you've borrowed, we recommend that everybody take their federal loans first before moving on to other options. And this is a big part of the reason why. There are a lot of options that you can take to repay these loans. So you don't have to repay these in the standard 10-year term. You can get on any number of plans to extend that repayment term and lower your monthly payment out to 25 years or so. So you can pay a lower monthly payment. Now, the one thing to keep in mind is that if you are taking longer to repay federal student or any student loans, really, or any loans, if you're taking a longer time to repay it, you're paying more interest. And so the overall cost may end up being higher over the life of the loan. So you just want to be aware of that as well. We're going to go over briefly some of the options some of the repayment plans that you can utilize. And it's a conversation that you should probably have with your servicer, because they can counsel you and run numbers and sort of figure out the way to get you the lowest monthly payment. But if you wanted to do some looking by yourself, there is a loan simulator on the studentaid.gov site that you can go in and plug in your amount borrowed, your balance, and some other information, and see the various monthly payments that you might be eligible for. But again, I also would probably recommend talking to your servicer as well, because some plans may be open to you and some plans may not, depending on the age of your loan. So how old your loan is and your economic circumstances and stuff, you may be eligible for some more than others, and some may be of more benefit to you. So I'm going to give you a glimpse here at the various repayment options. So the first one, as we said, is the standard repayment term, and this pays your loan off over 10 years. Now, if you can handle this and it's not onerous for you to make these payments, this is great, because you're going to pay it off in 10 years. And remember, the shorter you take to repay a loan, the less interest that you're going to pay. There's also a graduated repayment. It also takes 10 years, but the way this one works is it starts off at a lower repayment amount, a lower monthly payment amount. And then as you move through the program, I believe it's every 3 years, your payments increase, assuming that you're making more money and your salary increases over the years, your monthly payment increases over the years. But again, it's still going to be 10 years. Once you get past that, these are the extended repayment terms. So as you see here, extended is a fixed or graduated repayments. You need to have a $30,000 at least, and you repay over 25 years. Everything else on this list, and I'm not going to spend too long on this because this is quite literally its own webinar, which we will be, there's some changes to the income-based repayment plans that are going to be available shortly. And we're going to be having a webinar on that and sort of going through each of these options in detail and some of the changes that are coming up. So if you're interested in that, check out MEFA.org, or even better, you can sign up for our emails and we'll notify you when that becomes available. But the rest of the payments here after the extended repayment are all going to be based on the income of the borrower. And so you can see here, repayments may be 10% of the borrower's discretionary income. And certain of these programs have different sort of wrinkles to them. And this is why I said it's good to talk to a servicer, because you may look at one or the other and say, well, this sounds good, but maybe one takes into account if you're married, your spouse's income, and one doesn't. So things change depending on your economic circumstances, and also just on where you are right now. But the good news is that there are a lot of options available to you to lower your monthly payment and keep these payments as low as possible for as long as possible. And remember, I said there's no prepayment penalty. So you can get on a very low monthly payment that you're required to make a low payment, but you're able to pay off earlier. Now, for private loan repayment, there is not really as much there's really not as much latitude as there is with federal loans. There just isn't. So they have to be repaid usually within the term that they that they agreed upon with you when you sign the paperwork. So they're not as flexible to stretch out the term of that, or to lower your monthly payments, or to have certainly your payments based on the percentage of your discretionary income every month. When it comes to private loans, it really depends on your lender and your servicer. So if you have questions on repayment, anything ranging from interest rate to payment due date to how you can make payments to any kind of late fees or anything like that, you really want to talk to your lender or your servicer. So review the lender website, contact the servicer, see what the options are. And each sort of private loan is going to have their own features. As I said, across the board, they're much less likely to be able to grant the kind of flexibility that federal loans are. But you should still contact them, because there may be options. There are certain circumstances where you're just eligible for federal loan forbearance or deferment. Not the case, may not be the case with private loans, but there may be things that they can do. So they might be able to offer some forbearances. They may be able to temporarily lower a monthly payment or put you into a deferment. It really depends on each particular program and servicer. I said we're going to talk about forgiveness options, and I referenced the sort of blanket federal student loan forgiveness that was before the Supreme Court currently. Not going to talk about that because we just don't really know what's going to happen there. But aside from that, there are forgiveness options available that sort of predate that have nothing to do with that. And this is, again, on federal loans. This is federal student loan forgiveness. So what is forgiveness? It's when essentially the debt is just forgiven. Say you have an outstanding debt with the federal government or the federal direct student loans, and it just goes away. So it typically occurs for two reasons: a reward for doing something good, which is we'll talk about in just a minute, or relief if something really bad happens to you, which we'll also touch briefly upon. What I'm really talking about in the first example are these programs: public service loan forgiveness. That's probably the most popular and most widely used and inquired about program. There's another program called the teacher loan forgiveness, which I've had a little bit of experience with, not too much. Department of Defense loan repayment, AmeriCorps and Peace Corps loan repayment, and then Perkins loan forgiveness. We're not going to go over too many of those, just the first few and Perkins loan. But if you are dealing if you're in the military or in the armed forces, you can contact the Department of Defense about loan repayment, and AmeriCorps and Peace Corps as well through those agencies. So for public service loan forgiveness, this has been around since about 2007. And essentially it was designed because there are certain careers that you need a lot of education for that don't necessarily have a result in big salaries. And so there was designed to be a relief to some of those borrowers. And essentially what the program is if you are working for a qualified government organization or nonprofit, 501c3 not-for-profit organization or other qualifying nonprofit, if you are working there for 120 months and making payments on your loan, after that time where you have made 120 qualifying monthly payments, you can apply to have the balance of your loan forgiven. So if you can remember, the standard repayment term on these loans is 10 years. So it wouldn't make sense for you to continue on with your standard repayment, because after 120 months or monthly payments, you'd be paid off anyways. So in order to be eligible for this, you would want to get on one of the extended or income-based repayment plans. And then again, work for a qualified agency and be making payments for 120 qualifying months. It does not have to be consecutive. So you could work for 5 years in a qualified agency, leave and work in a non-qualified company, and then come back and later on you would start off at 5 years plus. So they can stack upon each other that way. Only federal direct loans qualify for these. So there were federal loans that are older. It used to be before 2009. I think private companies could act as federal loan lenders. It's called the FEL program. I think many of you probably don't, most of you, probably all of you don't have to worry about that. These are direct loans only. And the payments that are honored as going towards the 120 qualifying monthly payments have to have been made after October 1st, 2007. And so after this, you have to submit the public service loan forgiveness application after you make those payments. If you have questions about which employers count, or any questions about your public service loan forgiveness path, there is a help tool that's available. It's at studentaid.gov/PSLF. And there are, again, a number of free resources available, and we'll highlight one called the Institute of Student Loan Advisors, TISLA. They have, their website is freestudentloanadvice.org, I believe. We'll see it in the final slide, whether it's .org or .com. I think it's .org. And they're an excellent resource as well. So that is a really popular program, the public service loan forgiveness option. There are a couple of other programs, one of them being the teacher loan forgiveness program. And this is for candidates who are teachers. They have to teach in a school or agency that serves low-income families, and they're eligible for up to $17,500 in their federal direct student loans to be forgiven. During the time that they are teaching, that 5-year term that they're teaching in a school or agency that serves low-income families, their loan is placed into a mandatory forbearance. And so they have to recertify that every year that they are still teaching to qualify for that forbearance. And again, there's a blanket amount that is forgiven there, $17,500. The last forgiveness option here, I don't think any of you may qualify. I mean, the reason is this is for a particular loan program called a Perkins loan, which is actually not given anymore by the federal government. But there may be some Perkins loans. Some of you may have Perkins loans in existence from older Perkins loans, but I'd be surprised, but it's possible. And basically a percentage of the loan is canceled for each year that you are in a various type of public service position. So qualifying positions are Peace Corps, teacher, U.S. Armed Forces, nurses, law enforcement officers, Head Start workers, etc. If you have a Perkins loan and you think that you may be eligible for this, you can contact the college that you went to that awarded the Perkins loan for questions. I would be surprised, but it's possible. Now, those are the reward for something good forgiveness. There are also relief from something bad forgiveness options. So, things that we don't really want to think about, like death of the student or borrower, total and permanent disability of the student. If the college that you went to and took on the debt to attend, the federal debt to attend, violated a law, you may have seen in the news as of late, there have been some schools that have, for-profit colleges that have been deemed to have violated the law, and thus the students who borrowed for these universities had their loans forgiven. The same thing if a college has closed while you're attending it, while you're enrolled, your loans are forgiven. Now, the really important stuff here: avoiding and recovering from delinquency and default. I want to start first by talking about two terms that are close in meaning, but not necessarily the same. In fact, I think we just saw it earlier in the question: deferment and forbearance. And these are, when you're in deferment or in forbearance, essentially you're just not expected to be making any payments. Deferments, if you're in a deferment, your loan payments are postponed. So again, you're not expected to make any payments. and interest does not accrue on a subsidized loan. So if you have a subsidized loan, if a portion of your federal direct loans are subsidized, that means the government has been paying the interest on those for you while your loan is in deferment. So in-school deferment, for example, the government is paying that loan. On an unsubsidized portion of that, the interest is accruing. For a forbearance, again, loan payments are suspended or reduced, but interest does accrue on all loans. So that's really the big difference. In terms of when you would qualify for one versus the other, for deferments, you can apply for an unemployment deferment. So if you are in repayment and you've fallen on hard times because you've lost a job, you can contact your servicer and apply for an unemployment deferment. Any kind of economic hardship, you can apply for a deferment. If you're in a graduate fellowship, if you're in the military, and once again, of course, if you're in school, enrolled at least half-time, you are eligible for an in-school deferment. A forbearance, this can apply to things like medical or dental internships or residencies. You can apply for an economic forbearance due to hardship because of your excessive student debt burden. If you're in AmeriCorps, your teacher loan forgiveness program, as I said, if you're in that 5-year period where you're making payments, I'm sorry, not making payments, where you're teaching, you're in a mandatory forbearance there. And if you're in the National Guard or medical or other acceptable reasons, and your servicer can determine whether or not you qualify for a forbearance or not. But the interest accruing on the forbearance loans or on loans and forbearances is the big difference between deferment and forbearance there. Okay, now we talk about delinquency and default. Delinquency begins the day after the due date if the full payment is not made. So if your payment is due on the 28th of the month and it has not been received, by the 29th, you're 1 day delinquent. Some servicers report to credit bureaus 30 days after the repayment, after the payment due date has come and gone and there's no payment, you would be 30 days delinquent. Some 60 days, but regardless, when they start reporting, that's going to start to negatively affect your credit report. And the further delinquent you fall, the more it's going to affect your credit score and your credit report. Default occurs if no payment has been received after 270 days of delinquency. And I believe that is particular to federal, because I think private loans may have their own standard, maybe 180 days delinquent or 210 days delinquent for private loans. But I believe for federal loans, it's 270 days. So when that happens, your loan is said to be in default. And that does have a really pronounced and negative effect on your credit score and your credit report. Loan servicers try to prevent default by contacting you. So this is why they're calling you, and this is why you want to answer the phone. They will send a final demand letter at a certain point notifying you that your loan is about to go into default. Loan servicers, of course, want borrowers to keep making payments to help them save on interest payments, of course, in the long run. And so, again, servicers may be able to offer forbearances, deferments, lower monthly payments, especially if you are near default. You definitely want to get in contact with servicers. I can't say that enough. And just to let them know that, you are trying to repay and you want to explore options so that you can do that. So consequences of default, I said, it does have a pronounced and negative effect on your credit score and your credit report. It will be reported to all parties on your loan. I mean, anybody on your loan, whether it's students only on the loan or students and parents, everybody is responsible to repay if they've signed the promissory note. And if it's reported on your credit, it's going to affect all of your credit scores and credit reports. One of the consequences of defaulting on a federal loan is that you wouldn't be eligible to receive any more federal student aid while your loan is in default. Your loan can become due the full balance of it immediately. And you could be contacted by collection agencies, which is, it's like the loan is no longer with the lender anymore. It's with an agency, and they will be much more aggressive in asking for repayment of that loan than the lenders, and they won't have the same type of options available, of whether it's forbearance, deferment, or lower monthly payments. And again, for federal loans, you can lose eligibility for those types of things. And also with federal loans, your wages can be garnished, or your taxes can be refunds, if you're going to get a tax refund, can be garnished to repay that debt. So those are things that you definitely want to avoid. And federal loans in particular, as I said, they're very flexible in how they can be repaid. So there's just a lot of opportunity to avoid default, in particular with federal loans. But again, whether it's federal or private, definitely keep contacting your servicer. If you're in default, again, for private loans, there may not be options to get out of default. For federal loans, there are more options to get out of default. So you can repay the loan in full. That's essentially your option when it comes to private loans. And, it's difficult because if you could repay the loan in full, you probably would have done so before going to default. If you have federal loans, you can, agree to repay under an income-driven repayment plan and consolidate your loan. So there's an agreement that you can make with your federal loan servicer that way. You can consolidate after making 3 consecutive payments and rehabilitate the loan by making 9 on-time payments in 10 consecutive months. So there's ways out of default. And I know recently there has been a few initiatives, the Fresh Start initiative through the government, to help people within this sort of pandemic moment to get out of default and to reset their credit and their loans in good standing. So again, just another example of why federal loans are considered financial aid and private loans are not. Now, when it comes to managing your payment and perhaps reducing your monthly payment amount, a lot of people want to talk about loan consolidation and refinancing. And so they're similar in ways, but they're different. You want to think, once again, for federal loans, you're going to think about consolidation. And for private loans, it's refinancing. So federal loan consolidation combines all of your federal loans into one, or multiple federal loans into one consolidation loan. Remember, every time you borrowed money from the federal government to go to school throughout every year, that's a separate loan. So if you went for 4 years and you borrowed through the federal government each year in the federal direct program, you're going to leave with 4 loans. You can consolidate those into one loan. They'll average out the interest rates and have you make one payment. The loans have to be in repayment or in a grace period for you to do that. So they don't want people consolidating loans while they're still in college. And then through that consolidation, you're eligible for all these income-based repayment plans. So the repayment term is 10 to 30 years based on your debt amount and the repayment plan that you choose. You cannot consolidate a plus loan with your federal student loans. The borrower has to be the same. So I mentioned federal loans. I'm talking about the federal direct student loan program. So you can't consolidate a parent loan, which the parent is the sole borrower, into a consolidation loan with your federal student loans. And you also can't consolidate private loans. People sometimes say, oh, well, I don't want to make 4 different payments. I want to make one payment. So shouldn't I consolidate? Sure. But, for the most part, even if you have 4 separate loans, you're only going to be making one payment anyways. So, that's not really the reason to do it. Part of the reason to do it would be to consolidate to get on this income-driven repayment plan, or possibly pay a little bit less on if you have higher interest rate loans, and you can weight them with lower interest rate loans, sort of weight the average. There's no application fee to do that, and you can apply in studentaid.gov. Once again, one bill per month, probably not much different because you're probably paying one bill per month with your federal student loans anyways. Potential to lower monthly payment, access alternative repayment plans. So if you have loans that are older and maybe not eligible for certain repayment plans, you can consolidate them into a federal consolidation loan and then be eligible to be on an income-driven repayment plan. One thing you should be aware of is that I mentioned earlier that before every federal loan was a federal direct loan, some outside lenders could have lent federal loans. If you have one of those loans, again, I think the chances are slim, but if you have one of those loans, it's possible that there were some discounts that you had on those loans where, if you made a certain amount of on-time payments, et cetera, you may have gotten a lower interest rate. If you consolidate those loans into a direct consolidation loan, you would lose those benefits. So again, a conversation for your servicer if you think that may be an issue. And then if you are going to increase your loan term, remember, as I said before, the longer you take to repay, the more interest you're paying. So it could drive up your overall cost. But once again, as I want to remind you that even if you do stretch out that repayment term to 25 years or so, you don't have to take the full term to pay it off. So it could, you can set your monthly payment really low and then pay it early if you're able to do that. Now, when it comes to private loans, people want to consolidate their private loans, especially if they've got more than one lender for their private loans. So the term for that is to refinance, essentially. And what you're doing when you refinance is you're taking multiple loans, borrowing a new loan to pay those loans off with a new agreement. That way you are making one monthly payment. And that can really simplify things for people. You can include federal loans in with the private loan refinancing, but it's not necessarily recommended that you do that. And the reason is because federal loans do have that amazing flexibility associated with them. And then if you pay those off and refinance them in with private loans, you're going to lose all of those federal benefits that come with that. So you want to think really carefully before you do that. Many lenders have their own refinancing options. MEFA has them. A lot of private lenders have a refinance program. The reason I think to do it, one of the big reasons is you can get a lower interest rate if you apply for a refinance loan. They're going to base your interest rate on your credit, and especially if you've been making repayments on time on these student loans or these educational loans and your debt in general, you might have a good credit score and may be eligible for a lower interest rate and perhaps a lower monthly payment on these loans. And there are all sorts of repayment terms that you can get. You can pay it off in 15 years, 10 years, 7 years, etc. So the better your credit, once again, the lower your interest rate on these. Also, sometimes if parents are on loans and they want to be removed from loans, students can refinance without them. However, and that would remove them from the debt. However, especially students that have just graduated are probably unlikely to have the credit strength that it would take to have refinancing make sense from a monthly payment or lower interest rate perspective. So you may have to wait on that a little while. It's not going to work for everybody. Lenders who offer refinance loans should have calculators on their website that you can explore and see what you're going to be paying back every month and what your eligibility for these programs are, and if it makes sense for you economically to do this. So I would recommend that you do that and you run those numbers. Maybe you speak to a counselor at that refinance company to see if this is something that's going to benefit you or not. So consolidation, just to give you a brief rundown, once again, consolidation versus refinancing. Are federal loans eligible for direct consolidation? Yes. For student loan refinancing, they're eligible, but you probably don't want to you probably don't want to refinance them. See, I just did it with your private loans. Are private loans eligible for direct student loan consolidation? No. For student loan refinancing, yes. Is credit check required? Not for direct student loan consolidation, but yes for student loan refinancing. Can I lower my interest rates? No, with direct student loan consolidation, because it's just an average, and maybe for student loan refinancing, depends on the strength of your credit. Will I save money with direct student loan consolidation? Maybe. Generally, no. And student loan refinancing, maybe. And both of them, you'll get one bill and just be able to pay one bill. So again, factors to consider when you're refinancing. You only have to pay one bill per month. The reason to do it really is for a lower interest rate or lower monthly payments. And the ability to switch from variable to fixed interest rate or vice versa. If you have variable interest rates and you don't want that, you can refinance with a fixed rate, and again, or vice versa. One thing you want to be, again, cognizant of is that you may lose some borrower benefits with original loans. So your original loans that you took out has specific terms that were agreed upon between you and the lender. Once you refinance those, a new agreement has been made that supersedes those things. So you're going to lose those features and potentially those benefits, if there are benefits when you refinance. And once again, the increasing length of repayment results in a larger than total cost. Once again, the longer you take to repay something, the more it's going to cost you over the long run. But again, I'm not aware of any programs that have prepayment penalties, but I can't speak for every program. So make sure you do your due diligence. And if you do want to make any, if you do want to prepay, or at least want that as an option without penalty, make sure that you know ahead of time. So I mentioned that we're going to close by mentioning some resources. So MEFA.org, of course, we're, among other things, going to have that webinar very shortly about the new income-driven repayment plan and the changes made to public service loan forgiveness. So you want to keep on the lookout for that. Studentaid.gov, we've mentioned the tools. That is the federal site, the site for federal aid. So on your federal loan repayment, if you have questions about the various repayment plans or the public service loan forgiveness options, you can consult them. IRS.gov for info on the student loan interest deduction. You can find that there. Bankrate.com for calculators, rate comparisons, financial advice, as well as Credible. Compare loan and refinancing options. That's the site where you can go in and they'll do a soft credit pull, meaning it doesn't affect your credit score if you're thinking about refinancing, and it should give you the rates that you're eligible for at the various participating lenders in Credible. Annualcreditreport.com is your free annual credit report, which you should do. freestudentloanadvice.org. There it is. Okay, so it is a .org. I thought it was. Credit Karma. I think most of us know Credit Karma. Free credit score, credit reports, tips and tools, and Mint.com, a free financial management tool. So you can do your budget through Mint.com. Here's our social media information, and now I am going to take some questions. Okay. I'm not sure if you can see these. If you can, I may stop recording so that when you get this, you can cut that off. But in any event, I'm gonna read this out here. So when loans were on hold, did interest accrue? Well, it depends on the type of loan. The only loans on which interest does not accrue when you are in school or in an in-school deferment are the federal direct subsidized loans. On the unsubsidized loans, interest is accruing. On certainly any private loan, if you were in a deferment, there is going to be interest accruing on that while you're in deferment. And what happens with that interest is probably going to depend from lender to lender. I can tell you what happens in MEFA, and I think generally this is kind of what happens. But for us, we take all the interest that accrued throughout your time in deferment and add it to the principal when you go into repayment. And so that's called capitalizing. So the interest capitalizes once you enter repayment. And so if you can make the interest payments before it capitalizes, that's good, because what happens then is that interest starts to accrue on the larger amount of what you borrowed plus the interest. So if you pay it beforehand, once it goes into repayment, you're not going to get any capitalized interest. If a loan is held by a student as well as a co-signer, will all parties receive notices when the grace period is being entered and ended? Yes, all parties on a loan should be notified of any changes or anything. Typically, now it depends. I'll tell you, for private loans and for MEFA specifically, the primary applicant will receive the bill, at least at first. If a payment is not made, everyone on the loan will get a delinquency notice saying that payment has been missed. Now, again, with MEFA, every party on the loan has the ability to go in and make a payment, so they can go into the website, and if they create an account, they can go in and make that payment, or perhaps they can make it over the phone. It really depends on the lender, but they should be able to do that. But any changes like grace or entering repayment, all parties really should be notified. Will paying off your loan earlier negatively affect your credit rating? No, it will not at all. Good question. So what else besides principal would the extra money be applied to beyond the monthly payment? Okay, that's so it could be that if a servicer receives 2 monthly payments worth, they might pay this month and then pay next month when next month is due. It's different lenders and different servicers really have different practices there. If you have multiple federal loans, subsidized and unsubsidized, one for each 4 years, is the repayment plan consolidated into one repayment plan? So that's you'll have different loans. They'll be itemized 1 through 4, or you could consolidate them together using a direct consolidation loan. But either way, you should be making one payment on them, whether it's one loan through consolidation or 4 loans separately, as long as they're all the federal direct student loan. Loan forgiveness for a parent direct plus loan that are disabled. So if the parent is if the borrower on the loan is in permanent and total disability, it's possible. So you should contact your servicer, and they can send you the application and whatever it is that they need for documentation for to have that discharged. Can consolidated loans be paid off early without penalty? Yes. Will this webinar be repeated? You'll get the recording emailed to you. And will MEFA present a webinar for Parent Plus loans consolidation? So we don't have anything planned for a specific webinar on that, but if you have questions, you can certainly contact us and we can help you out to a certain extent, or you may just want to contact your servicer as well. We can discuss it when you call. Any other questions? All right, well, thank you everyone for attending. I almost finished in time, so thank you. I appreciate your attention, and good luck with everything. If you have any further questions, this is our contact info here. Thank you.